What if the next great DeFi revolution is not being built by a new project at all? What if it is being led by one of crypto's oldest survivors? A protocol that refused to die and is suddenly rewriting the rules of on-chain trading. What if the future of decentralized derivatives is not about speculation, but about architecture? That project is Synthetix. And after this video, you may see the entire DeFi landscape in a different light. Let us start with where the market stands in 2025. Bitcoin and Ethereum ETFs are no longer theory, they are a structural part of global capital flow. The US Federal Reserve has entered a rate-cutting cycle. Liquidity is returning to risk assets. Asia and Europe are accelerating tokenization frameworks. And institutions from hedge funds to pension desks are exploring blockchain infrastructure, not for yield farming, but for execution. This is the quiet phase of a new bull market. The phase where speculation dies and infrastructure takes over. And in that environment, few narratives are stronger than the return of decentralized derivatives. But here is where it gets interesting. Most people think the derivatives revolution started in 2020 with Uniswap and Perpetual Protocol. In reality, it started long before that in 2018 when Synthetix launched under a different name, Havin. Its vision was radical at the time. A system where anyone could mint and trade synthetic assets, that's on-chain representations of real-world value without middlemen. It was dismissed as too early. Gas was expensive, liquidity was thin, and derivatives were considered a luxury use case. But history has a way of rewarding builders who survive. Synthetix did not fade away. It evolved. Through multiple bear markets, it kept iterating, refining its architecture, fixing incentives, rewriting contracts. And now, in 2025, it is back not as a relic, but as one of the most powerful engines of DeFi infrastructure. The macro backdrop matters here. Traditional derivatives markets, futures, options, swaps represent over $1 quadrillion in notional value. That scale cannot move on-chain overnight. But the migration has started. When Ethereum 2025 upgrades finalized dank sharding and rollup compression, settlement costs dropped by 80%. Suddenly, derivatives protocols could execute high-frequency trades without destroying margins. At the same time, new stablecoin frameworks and real-world asset tokenization provided reliable collateral. The stage was set for a DeFi derivatives renaissance. And Synthetix was perfectly positioned to lead it. Now here is the part most people miss. Synthetix is not an exchange. It is the liquidity layer that exchanges plug into. Think of it as the engine beneath the surface powering synthetic assets, perpetual futures, and on-chain derivatives for a growing ecosystem of front-end platforms. Instead of matching buyers and sellers directly, Synthetix uses a pooled collateral model. Traders interact with the system, while SNX stakers provide liquidity and take the opposite side of every trade. This creates deep, permissionless liquidity without traditional order books. The result is simple but profound. Anyone can trade synthetic assets with minimal slippage, and anyone can earn yield by backing the system. That design was revolutionary years ago, and in 2025 it is finally mature enough to scale. But let us look at what changed technically. Because this is not the Synthetix you remember from DeFi Summer 2020. This is Synthetix version 3. Completely rewritten from the ground up, modular, multi-chain, and battle-tested. Version 3 introduces atomic settlement, dynamic liquidity provisioning, and cross-margin accounts, features that align the protocol with modern exchanges. It also enables permissionless synthetic asset creation through smart contracts, meaning developers can build new markets for anything commodities, indexes, even AI tokens in minutes. The architecture runs natively on Ethereum Layer 2 like Optimism and Base, using optimistic rollups for speed and cost efficiency. Each trade is confirmed within seconds, secured by Ethereum's finality. This brings Synthetix into direct competition with centralized exchanges in terms of latency and execution, but without custody risk. And that changes everything. The real story starts here. Because Synthetix is not just rebuilding itself, it is powering an entire derivative stack. On top of Synthetix Liquidity sit projects like Quenta, Polynomial, and D-Hedge, interfaces where users trade perps and Synthetix using Synthetix Liquidity. Each of those protocols now processes hundreds of millions in daily volume. Together, they represent the rebirth of DeFi derivatives, transparent, composable, and capital efficient. And as Synthetix unveils its new mainnet competition, a $1 million campaign inviting traders to stress test its perpetuals engine, the market is paying attention. Trading volume has surged. Social mentions have exploded. SNX itself rallied more than 120% in a single week, a move that woke up every institutional desk watching DeFi metrics. Now here's the twist. This comeback is not speculation. It is design. While retail investors chased memes and AI tokens, Synthetix quietly rebuilt the foundation for derivatives infrastructure. Its tokenomics are different now. Under version 3, SNX stakers provide collateral that underwrites synthetic assets and receive trading fees directly, a model that aligns incentives without relying on inflationary rewards. Liquidity providers can choose markets, risk parameters, and leverage, transforming Synthetix into a marketplace of collateral. It is not yield farming, it is risk farming. The more accurate your risk pricing, the higher your yield. And that mechanism, combined with transparent on-chain data, is attracting the kind of capital DeFi has been missing since 2021. But this raises a bigger question. Why now? Why is the DeFi derivatives sector reviving in 2025 after years of dormancy? Part of the answer is macro. Institutional adoption is finally catching up with on-chain infrastructure. BlackRock's tokenized T-bill funds, Fidelity's digital commodities baskets, and CME's experiments with on-chain settlement have normalized DeFi derivatives for regulators. Meanwhile, Ethereum Layer 2 fees are negligible compared to 2021. Combine that with AI-driven trading bots and 24-hour on-chain liquidity, and the stage is set for massive growth in synthetic markets. Synthetix just happens to be the best positioned player to capture that demand. If you value deep research like this, subscribe to Crypto Wayfarer. Because understanding these shifts early is where the edge is found. Let us go deeper into the architecture itself. At its core, Synthetix functions through three key components. The first is the collateral pool backed by SNX tokens that secure the system. The second is the debt pool, a dynamic representation of all outstanding synthetic assets. The third is the exchange contracts that manage trades and settlements. Every synthetic asset, or synth, derives its value from an Oracle price feed provided by Chainlink. When a user trades, the system updates balances within the pooled debt model, meaning liquidity is always available, without the need for counterparties. This architecture removes the problem of slippage and thin order books that haunt other DeFi protocols. And because it is all on-chain, every transaction is verifiable, auditable, and transparent. But here is where things take a turn. The same mechanism that enables infinite liquidity also introduces risk. If the collateral value drops too fast, the system can become under-collateralized. That is why Synthetix has spent years perfecting risk parameters requiring stakers to maintain ratios above 400% and using automatic liquidations to protect the network. It is a balancing act between efficiency and security. Yet the fact that Synthetix has operated since 2018, without a major exploit, speaks volumes about its resilience. Let us compare that to the broader DeFi landscape. Projects like GMX and DYDX popularized perpetual trading on Layer 2, but they still depend on segregated liquidity pools and limited markets. Synthetix differs by being a universal liquidity layer that other protocols can build on top of. It is not a competitor to those platforms, it is the infrastructure beneath them. This approach mirrors what Ethereum did for smart contracts. It created standards others could use to expand the ecosystem. Synthetix is doing the same for on-chain derivatives. Now let us talk about the money flow. In early October 2025, Synthetix announced its mainnet perpetuals competition with a $1 million reward pool. Within days, open interest across Synthetix-powered platforms tripled. Google search volume for SNX token rose by 180%. Twitter mentions and Lunar Crush scores spiked sharply. On-chain data showed a return of long-term stakers and new wallet creations at multi-year highs. This was not random hype, it was a response to a structural shift in DeFi liquidity. And this is where institutional adoption comes in. Market-making firms that once ignored DeFi are now using Synthetix to test on-chain hedging strategies. By providing synthetic exposure to commodities and indexes, Synthetix acts as a sandbox for regulated trading firms to experiment without custody risk. Some of these firms are now collaborating with Synthetix DAO to design new Oracle standards and liquidity guardrails. This kind of co-development between DeFi and TradFi was unthinkable just 2 years ago. Today, it is happening in real time. But let us address the other side of the equation, the risks and realities. Synthetix still faces competition from both centralized and decentralized derivatives platforms. Regulatory ambiguity around synthetic assets could limit mainstream integration. And because Synthetix relies heavily on Oracle data, a large-scale Oracle failure could impact pricing accuracy. Moreover, token volatility remains a factor for stakers. An SNX drawdown reduces collateral efficiency and can trigger forced liquidations. The team is addressing this by diversifying collateral types and introducing synthetic stablecoins like SUSD as core liquidity assets. Still, these are the trade-offs that define pioneers in unexplored territory. Now, let us look forward. Synthetix's roadmap for 2025-2026 focuses on 3 themes. Expansion beyond Ethereum Layer 2 onto cross-chain networks like Arbitrum and Base. Integration of real-world assets and tokenized treasuries into the synthetic markets. And the launch of the Synthetix V3 Perpetuals exchange as a fully modular protocol that can be embedded in any front end. If successful, Synthetix will no longer be just a DeFi project. It will be a liquidity primitive, a base layer for derivatives on any chain. That is the same trajectory we saw with Ethereum and with Cosmos in their early days. This brings us to the strategic takeaway. The market is repricing infrastructure. Investors are moving from narratives to mechanics. They want protocols that generate real fees, not just tokens that trend on social media. Synthetix fits that shift perfectly. It is a battle-tested system with measurable cash flows, clear use cases, and a history of delivering through multiple market cycles. In a world where AI projects and meme tokens rise and fall overnight, Synthetix offers something different: durability. And durability is what institutions buy. Let us zoom out one last time. When you look at Ethereum 2025 and the growth of blockchain infrastructure, you realize that the real battle is for execution. Not who can market the best narrative, but who can settle the most value safely and efficiently. Synthetix has spent 7 years building for that moment. It has survived multiple bear markets. It has rewritten its own codebase while others abandoned theirs. And it is now being rewarded for that discipline. The 120% surge you saw this month is not the end of the story. It is the beginning of a longer cycle, one that could make on-chain derivatives a core pillar of the global financial system. So ask yourself this: if synthetic assets become the default way markets trade commodities and currencies on-chain, who controls the pipes? If institutional liquidity flows into DeFi derivatives, which protocol already has the architecture to support it? And if blockchain infrastructure becomes the execution layer for the next financial era, which project has proven it can survive long enough to matter? The answer might be Synthetix. Stay sharp, stay strategic, and keep wayfaring.